It's 6 o'clock in London. It's 1 p.m. lunchtime in New York City, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, wherever you are in the world today. My name is Patrick L. Young. The IPO-VID Livestream, Series 13, Episode 1, that is episode number 73, starts here. Now, here's an interesting statistic that's been buried in various strands of news media recently. China's crude oil imports from Russia have jumped 55% year on year, reaching around 2 million barrels per day. Not only is China benefiting from the steep discount, around 30% or thereabouts, available to buyers of Russian sanctioned oil, it also means that for the first time, Moscow is now selling the most oil to China ahead of erstwhile largest supplier Saudi Arabia. Staying with that oil theme, with the squeeze in oil prices and, of course, those deep discounts in the market available to those who are going to buy Russian-sanctioned oil, Russia is likely to make $320 billion selling energy this year, an increase of 35% on 2021. Up to $60 billion of that sum could be coming from Germany alone. In the parish of exchanges, congratulations to the outgoing BSE, that's used to be the Bombay Stock Exchange, CEO Ashish Chauhan, who's making a prodigal son return to the National Stock Exchange, where he was on the founding team all those years ago. All the best to Ashish as he endeavours to guide NSE and improve its reputation after recent scandals. Meanwhile, in Big World, I found a fascinating statistic the other day. According to Chainalysis, some $3.2 billion in cryptocurrency was stolen from exchanges and DeFi apps during 2021. That is 100 times the total average of all US bank robberies, according to the FBI. At least there's good news, a sort of silver lining in some way, shape, or form to this huge issue with the recent bursting of the crypto bubble and, of course, the crypto winter being upon us. Ceteris paribus, the good news is we're on target to have only 40 times as much crypto theft as US bank robbery proceeds this year. Our guest today is James Falk. He's going to be discussing his new book, Financial Cold War, and the greater macro around the incredible situation surrounding China's financial rise. James is a veteran financial and strategic advisor to corporations and governments. He served as senior executive at Hong Kong exchanges from 2012 until 2021 during a period of rapid internationalization in China's capital markets. While at HKEX, he played a major role in a number of landmark financial market initiatives, including the launch of the Shanghai-Hong Kong Stock Connect program in 2014, Bond Connect in 2017, and the Hong Kong market's listing reforms of 2018. Prior to Hong Kong exchanges, James was working as an investment banker in both Europe and Asia, specialising in the financial services sector. James, as I mentioned earlier, is the author of this riveting new book, Financial Cold War, and has written and spoken extensively about market structure issues and the intersection between geopolitics and international finance. James, good day to you. Where in the world are you today?
Good day to you, Patrick. Thank you for that extremely kind introduction. I'm on the island of Nantucket right now, off the coast of Massachusetts.
Wow, the island of Nantucket, which is the sort of place that gets completely lost in the United States of America, but is actually, I think, significantly larger than Gozo, if not getting on for the size of Malta itself. Quite a fascinating altogether. The sizes of small islands within small countries that people don't manage to notice. Great to have you on the show. Thank you very much to those who are already saying hello. Les Calvert, good evening, everyone. He's saying he'd rather have an ice cream, Marcus. Marcus has obviously been the man to kick it off. Ah, yes, Marcus Ward. Good evening, everybody. It's a bit chilly tonight. I think I might put the central heating on. Smiley face. Of course, he's saying hello to us today from the United Kingdom, where it's actually warmer than the Caribbean, I do believe, at this point in time. Hello to Peter Bridgewater. Great to see you in the Bahamas, Peter. Peter is a technological eminence grise of the Bahamian banking system going back many decades. Lovely to see you joining the show. Thank you very much for being part of IPO-VID. And thanks to Les, as I mentioned earlier. Great to see you joining us today. So, James, you are today in Nantucket. That obviously is a great thing because it means that you're not putting matchsticks in front of your eyes to come to us live from Hong Kong. What was it like actually leaving Hong Kong just the other week? Because clearly COVID remains a bit of a worry in your part of the world.
Yeah, it does remain a bit of a worry, and there's still significant travel disruptions. Our original flight out of Hong Kong got cancelled, and so we ended up having to fly a few days later than we expected. But they've recently announced that they're going to stop cancelling or blocking airlines from coming in if passengers test positive for COVID on arrival. So hopefully, gradually, things will start getting a little bit back to normal. Although I think that it's likely to take a little while yet before we're back to complete normality there.
Yes, it's quite incredible, the whole COVID thing, because certainly the latest variant, which I've got completely lost into where they are now, they gave up on letters of the Greek alphabet, at which point in time I was completely and utterly confused as to where we'd gone. But the latest derivative, I say, has been spread by, I think, vast numbers of summer parties. Ironically enough, we were invited to one a few weeks ago in Malta, which was called the Back to Normal Party, at which point in time the club promptly nearly had to close down because everybody got COVID, or at least half the people who were there, unfortunately. At least it's a milder disease these days. So tell me, you're born in Hong Kong. You had, I do believe, an exciting and peripatetic education overseas.
I did. My parents chucked me off to a Scottish boarding school when I was about 10, and then after that I had the opportunity to study in Beijing as an undergraduate before heading back to London, where I started working as an investment banker, and spent some years there. Spent a few years working in Russia and the CIS region, and then moved back to Hong Kong with my wife in 2008. And through a sort of serendipitous confluence of events, ended up advising the Hong Kong Exchange on the London Metal Exchange acquisition in 2012. Then ended up working there at the Hong Kong Exchange for almost 10 years after that.
So you have an interesting pedigree then. You, like Matt Chamberlain, were sucked from advising on the LME acquisition into the body corporate of Hong Kong Exchanges itself.
Yes, that's right. Look, I mean, it was quite a different organization back then. I mean, when I first showed up to help with the acquisition, we were working on this deal in London. I picked up the desktop phone on my desk in the Hong Kong Exchange office and realized that they didn't have international direct dialing overseas. So in order to be able to dial up your advisors in London, you had to get a secretary to come along and sort of plug in a load of codes before you were able to dial out. So it's come an awfully long way since then, and we're very lucky at that time to get people like Matt on board and various others who completely transformed the exchange from what it was back in 2012 when I started.
Yes, it's been an incredible decade altogether for Hong Kong exchanges, and indeed an incredible decade for China. I mean, there must be a very marked contrast between the time when you were a callow youth just finishing your education as an undergraduate and sitting in Beijing, compared to the incredible movement there's been even over the course of that couple of decades.
I mean, it was extraordinary. And, I had the really good fortune to have been an undergraduate in Beijing just after the handover of Hong Kong back to China. And it was really an extraordinary experience because China was moving so fast at the time that there was just this incredible hunger and incredible initiative of almost everyone that you saw around you to advance themselves economically. I remember at the time, I mean, it's extraordinary to think back now, but I don't think I've ever felt relatively so well off anywhere in my life ever since. The average, or I think the average household income in Beijing in those years was around about, it was just under $100 per month. So you know, if you had a reasonable allowance, I mean, you really lived like a king. And then you go back today, I mean, the city is almost unrecognizable. I mean, you've got all these huge skyscrapers all around. You've got modern infrastructure. You have a subway. Instead of we used to ride around in bicycles to get around everywhere in town. Now everyone's driving around in fancy cars, and you know, you don't have the traffic gridlock associated with that. So it's quite a different place.
Yes, quite incredible altogether to think that at that point in time it was actually poorer than Haiti is today, and yet has managed to advance towards an incredibly different place over the course of just 25 years. It's quite remarkable altogether. And actually, I mean, the rise of the Chinese financial marketplace, the rise of the Chinese economy, that drove you towards the idea behind this book. So tell us a little bit, I mean, how did you get the concept for Financial Cold War?
You know, I was an investment banker when I went into the exchange, and I had very, very little idea about financial markets policy and the enormous impact that has on societies and livelihoods. And you know, when I started to appreciate some of what was happening, it also happened to coincide with us beginning the stream of work that culminated in the Stock Connect programs that you have today. And I negotiating with my counterparts there, I was just struck by how little, although I'd lived in China or Hong Kong for a very large part of my life, how little I really understood about the evolution of China's financial markets, how they'd come about within the context of China's political development. And you know, when you point to a lot of the problems that still exist, I think a lot of people just have no conception of how far China has really come, and that the constraints, the massive constraints within which Chinese policymakers have operated. I also happen to have an American wife, and so have had the opportunity to spend an awful lot of time in the US and to get to understand the US, not just in the work sense, but in the sense of understanding people's daily lives, their daily cares. And I realized that there's just an awful lot of talking at cross purposes between the two sides when they discuss their interactions with each other, and particularly in financial markets. I think that this is an area which is so important to both sides. It's a critical part of the relationship because of financial markets' impact on society at large and on people's livelihoods. And I realized from my interactions with policymakers on both sides that this was an area that was really not well understood, and where there was a very significant failure to understand where the other side was coming from. And so that really was my motivation for writing the book, to try and help explain to people so they could understand what the real issues are in that financial relationship between China and the United States that unfortunately has been getting more fraught in recent years.
Well, it's certainly, I mean, it's a remarkably fraught relationship simply because China has grown so fast and therefore it's been an incredible shock to the system. Although I'm not quite sure, is the rise of China, is it equivalent to the United States rise, say, in the later 19th century, or has it been faster still?
It's been faster. It's been much faster than the US in many ways, but also in terms of the nature of its rise, China, the US really rose as an economic power and as a military power pretty much simultaneously, whereas China very much for most of the last 40 years has placed the emphasis on economic development and to drag itself up from the abject poverty in which the country found itself after the Cultural Revolution. And so I think as China has developed, there are various dimensions to the relationship, and obviously there's a diplomatic and a military dimension to the relationship, but the financial relationship between the two countries is critically important, and the financial markets are really where resources of society are allocated around society, and where those allocation mechanisms go wrong because of imbalances in financial policies or poor incentive structures that are created by the structure of the markets or financial policies, you can quite easily see tensions build up both domestically and between the two countries. And unfortunately, I think that's where we've landed now.
So we've landed now. We've got this incredible degree of general all-round, I suppose, a pervasive suspicion. You say that it's really being driven by fundamental misunderstanding, or at least a difficulty on both sides in order to manage to communicate and get forward. So how does your book cut through that in order to try and illuminate and elucidate people on both sides or neither side that are simply onlookers trying to work out how this goes forward?
Well, the central thesis of the book is that the fraught relations or geopolitical tensions are being driven largely by the spillover of domestic tensions. And the domestic tensions in both countries are respectively being driven by the rise in wealth and income inequality, the huge rise that you've seen in recent decades. And so the book is an attempt to explain the structure of the two separate markets, how those imbalances have been created, and then in turn how the imbalances have resulted in the rising geopolitical tensions that we've seen. And the simple answer to that really is that policymakers on both sides, rather than addressing the root causes of their domestic problems, have tended, unfortunately, to resort to the rather simplistic rhetoric of nationalist populism. And my great fear is that as that persists, it gradually removes the ability to de-escalate conflicts, but particularly when you have unforeseen events or where accidents occur, or where events occur which are sometimes outside the control of either party, as we've seen more recently, tragically in the Ukraine.
So that's very interesting. Look, ladies and gentlemen, I'm here talking to James Falk. He's the author of that book, Financial Cold War. The topic tonight is discussing financial Cold War. It's the relationship between the Chinese marketplace and the US marketplace, how those have evolved over time. If you've got a question for James, ping it in. We're talking about financial Cold War this evening. Let me say hello to Peter Sekon. We heard mention of domestic Cold War and other worries just the other day. I think actually James was talking about the homelands in China and the USA rather than anything to do with Peter's homeland. Hope you had a good weekend, Peter. All's well with the sun and air, Ari as well. And let me say hello to Simon Huckle. Good evening, everyone. Yes, I hope you're staying cool and calm in the United Kingdom there, Simon, because I believe that it ain't half hot, mum, at this juncture in the course of the day. So thank you to that. Do please ask us a question. Back to James. James, it's very interesting when we're looking at this whole relationship, the fundamental relationship between the different parties here. I mean, China is a fascinating market because in the early 1990s, it seemed all to be go, go, go with its financial market structure. And then it almost got completely disassembled, certainly on the futures, options and derivative side, and gradually rebuilt. Did that have a huge impact on the way the market structure was reconstructed at a later date?
That's a very good question, because China's markets are quite unusual compared with most markets around the rest of the world. I think you first of all, even before you get to the 90s, you have to go back to understand that China's growth has been very much driven by not just a huge population boom that and boom in the working age population that coincided with the beginning of Deng Xiaoping's reform and opening up in the late 70s, but also because the state, unusually for an emerging market, very much eschewed foreign borrowing and instead harnessed Chinese savers' savings to invest in infrastructure and other development priorities. And that investment through the 1980s and through the 1990s was really what laid the foundation for China's massive export growth. So from the outset, China's markets were, as they were going through market reforms, China's markets were never really free in the sense that they weren't entirely pricing or allocating capital on a free market scale. There was a heavy dose of intervention from the state. And then you went forward to the early 1990s, after the two stock exchanges have been created, and you had the initial rise of derivatives. You had a series of scandals, which are quite typical for emerging markets, misappropriation of funds by brokers, various kind of booms and busts because of very speculative retail investor behavior. And the Chinese government, and you have to think back to the fact that that was coming on the heels of a huge student protest movement in 1989. The Chinese government was very focused on ensuring social stability and ensuring that the introduction of market forces wouldn't undermine its society. And so China basically kind of largely hollowed out its broker sector and created incredible transparency in their financial markets by effectively requiring every investor to open an account effectively done through a broker, but directly with the exchange and directly with the clearinghouse. So unlike in other markets, China's exchanges and regulators have an incredible level of transparency right down to the level of each individual investor. Then when you when you subsequently had various kind of bouts of volatility in markets, you also had the regulator, the CSRC, coming in to intervene quite significantly to really bail out a lot of these a large group of retail investors out of very poor investment decisions. And so that accounts for the fact that the reason why China's domestic financial markets to this day, although they've come on leaps and bounds in the last couple of decades, they remain heavily underdeveloped relative to the size and importance of China's economy. And it is also the reason why, rather than Chinese companies going and IPOing in Shanghai and Shenzhen in the 1990s as they began to privatize and as the private sector took off, most of these IPOs ended up going to Hong Kong, which operated a relatively free capital markets and an open system of capital and currency movements.
Really very, very interesting. I'm going to pause that strand for just a second because actually I want to take a question. We have got a question from Peter Secon. What's the most explosive risk in the relationship between the US and China today, especially given the current Russian land grab?
I think the most explosive risks around China and the US really are domestic social tensions spilling over, and the problem is that many of the flashpoints, whether it's Taiwan, whether it's over the South China Sea or other things, these are well known about, and although the relationship has been rocky in the past few years, that both sides, militaries and both sides policymakers, have developed relatively set forms of dealing with some of these issues. And neither side, I believe, wants to end up in some sort of violent conflagration. So that the issues are more likely to come from accidents or misreadings of either side in the event of unforeseen events. And so you can take Ukraine as an example of that. I mean, I think Chinese policymakers were as shocked as everyone else over the Russian aggression in the Ukraine. Now, China doesn't necessarily have the luxury of Western countries insofar as their dealings with Russia go. They share a 2,600-mile land border with Russia, and Russia is critically important to the security and stability of a number of Central Asian countries on China's western border. The fact of fears about the US control or US naval control over the Malacca Strait, through which China imports most of its commodity inputs, and critically, China is not self-sufficient for either food or energy. So that is a very serious vulnerability if anyone ever decided to try and block off shipments into China for that. For that reason, China has in recent years been buying more and more food and energy across the Siberian border from Russia. So in that sense, this has created a significant dependency by China on Russia. And so when you read in the international press, I think that there's quite a lot of quite naive comment in there that China's out there kind of supporting the Russians in their aggression against Ukraine. The reality is that if you take a cold, hard calculation based on China's circumstances, China simply cannot afford to throw Russia to the wolves and cannot afford for Russia to become destabilized. Unfortunately, that has created some level of consternation in both the US and in Western Europe, where many people don't necessarily have the full picture or understand the full picture of China's predicament, and hence that there's been a call to levy sanctions on China as well. But when you think about this kind of sanctions stuff on China, I think this is quite dangerous, because the reality is that although most of us think of China as a major exporter, the reality is that China is a major re-exporter. But most of its export goods are depend on imported commodities and inputs from other parts of the world. And most critically, as I said before, China is not self-sufficient in either food or energy. So when you look at the threat of sanctions and the threat of containment of China, that this, when viewed from the perspective of Chinese policymakers, is perceived as an existential threat to them, which predictably, I believe, would draw, if these threats are ever carried out, would draw a response commensurate to the level of threat that Chinese policymakers feel. And so my answer in summary is that the biggest flashpoints in China are not likely to be the ones that are well known and well studied, but in unforeseen events where the two sides do not sufficiently grasp where each other are coming from, and that could very well lead to catastrophic miscalculations in their responses.
Yes, I think it's very interesting. And I mean, we're discussing here financial Cold War. Thank you very much for the question, Peter. Second, very, very stimulating answer, James. We're obviously concentrating on the Chinese side of the equation at the moment, but I think one thing that really you must look at, ladies and gentlemen, is this book, Financial Cold War, because it gives a very balanced understanding of the situation, both from a US and Western perspective and also from a Chinese perspective. But we're concentrating rather on the Chinese questions this evening, because obviously it's not often that we get a China expert on this show. And in fact, Peter Best asks a great question, which was one I actually was thinking of asking myself. So thank you for preempting me, Peter, with actually a more detailed question. Demographics. What are your thoughts, James, about China's aging population, and what will that mean for China's foreign policy and financial market internationalization?
Well, that's a great question. Thank you, Peter, for asking it. The biggest driver of China's extraordinary economic development over the last 40 years was the one-time boom in working age population, coupled with the fact of the one-child policy that existed for more than 2 decades, which led to a massive reduction in the number of dependents relative to each working age population. That's a trend that's now going in reverse. China has one of the most rapidly aging populations of any major economy or society. And as you've seen in Japan over the last 20, 30 years, that is likely to lead to very significant shifts in the economic dynamics for the country. And most critically, from a policy perspective, China has an unfunded pensions regime like in the United States. And unfortunately, because of the underdevelopment of its financial markets, it's got an extremely imbalanced allocation of savings. The largest destination for Chinese household savings has been residential property. That accounts for 78% of urban household wealth in China, compared with around 35% in the United States. The second largest pool of China's savings actually sits in the form of bank deposits, which totaled across the country around 35 trillion US dollars as of the end of 2021. You could see very clearly that if China is to ensure that this aging population is able to keep themselves in a relatively comfortable standard of living to which they've become accustomed now, through what will hopefully be a long and healthy retirement, they need to ensure that those savings are more efficiently deployed so as to generate better returns and better yields for China's savers. The unfortunate thing is for China is that the domestic capital markets, large as they are just simply not deep enough or developed enough to absorb anywhere near that amount of savings within a short space of time. And so inevitably, Chinese policymakers are going to have to find ways of helping Chinese savers invest that capital in capital markets overseas. This is where a significant part of the rub lies, in that today, any Chinese outbound investment outside of mainland China beyond Hong Kong is entirely dependent, or the investor is entirely dependent on a Western controlled financial infrastructure of payment networks, of international depositories, of global custodian banks. And Chinese policymakers have taken a very simple look at the means of effecting financial sanctions on Russia, but particularly since 2014. And they've realized that they cannot possibly put themselves at this financial security risk. And so you've got right now, unfortunately, a rather sort of unfortunate stalemate, in which it would clearly be in the West's interest to get access to more of China's savings that could drive, here in the United States, where I am right now, an incredible upgrade or capital availability for upgrades in infrastructure and other things which are long overdue here. But because China doesn't feel secure to allow that capital to flow out of the country, instead that they're stuck with the mechanisms for investment overseas, which in themselves create other tensions. So the Belt and Road Initiative is a good example of that. But because there's no secure means for Chinese individual investors or Chinese portfolio investors to invest overseas, most Chinese outbound investment continues to take place through Chinese corporates, and particularly state-owned enterprises, which are a major force within the country. And that inevitably leads to tensions around, or concerns around, the level of Chinese government influence, the level of Chinese government control, the amount of technology transfer, the amount of jobs transfer. Whereas if you had 1,000 Mrs. Wangs from Shanghai who were able to go out and buy a few shares of Amazon, or they were able to buy a few shares of Alphabet, that would not generate any geopolitical tensions whatsoever. And so this is where I think, better understanding between the two countries and a more grown-up set of conversations, frankly, around the way in which Chinese financial markets become integrated into the rest of the world would play a significant role in reducing the very scary level of tensions that we are now seeing between the two countries.
Wow, there's a lot to unpack there. Thank you very much, Pete Best. That was a better question you asked than the one I was thinking up for myself. So I really appreciate that coming to us from Nassau in the Bahamas today. We're here discussing Financial Cold War with James Falk, the author of the book Financial Cold War, and we're discussing the rise of China and its interrelationship to financial markets. And you raised another very, very interesting point there amongst many, James, which intrigues me, which is this whole idea of how money can potentially come out of China to invest in the rest of the world. But obviously there's a considerable worry about that ending up tied up in the US dollar-centric Western payments network, and therefore seeing that being possibly cut off if China is deemed not to have done something that appeals to or is in the best interests of the USA or elsewhere. And that's quite fascinating. So how do you think then the Chinese do get to this stage? Is it a fact of there are going to be intermediary steps before Mrs. Wang is able to buy her shares in Google? Or is it going to be a case that she's more likely to look for opportunities closer to home where a payment network can be built? So therefore, the bridge to Hong Kong may ultimately also then become a bridge to, say, Manila and the Philippines or Indonesia or elsewhere in Southeast Asia.
Well, that's an excellent question, Patrick, and I think the simple answer is that Chinese policymakers have been wavering over this issue around how to internationalize their capital markets and whether and how to internationalize their currency. The fact is, today, unfortunately, although the US dollar is viewed as an exorbitant privilege that favors the United States at the expense of other countries, the reality is that it is really a mixed blessing, in that the US dollar has meant, or the US dollar's primacy in global financial markets and global trade has meant that the United States has been almost alone in having to bear the absorption of all the financial imbalances in the rest of the world. And this is manifested in a massive loss of industrial competitiveness in the US, because the currency has been significantly overvalued due to all this global demand. And Chinese policymakers have looked at this, and they've been very reticent about, although there are people out there who believe that there's some mellifluous ploy for on the part of Chinese policymakers to internationalize the renminbi and usurp the global role of the dollar. Nothing can be further than the truth. I mean, this is something that Chinese policymakers have looked at, and they've been very wary about allowing their own currency to play this international role, which you can see manifested in the stop-start way in which reforms have been carried out over particularly the last decade. But the fact of the Ukraine situation and the unprecedented level of financial sanctions that have been put on the Russian, I mean, the freezing of Russia's foreign exchange reserves, whatever your view of the morality of the circumstances, opens a can of worms that I think is going to be very difficult to be able to kind of put back or be able to dial back the clock on. And I believe that not just China, but every single reserve manager outside a very small group of US allies must now be taking a very long, hard look at the allocation of their foreign exchange reserves. And China is no different. China has $3.2 trillion of foreign exchange reserves, of which around 1.1 trillion is in US dollars. And this makes them extremely vulnerable. Now, there's a risk that always was theoretically there. But I believe that the Western sanctions on Russia more recently have crystallized this into something more akin to an imminent and real threat to them. And I believe that Chinese policymakers will have no option but to pursue an accelerated internationalization of their currency in order to reduce their dependence on the US dollar system. In many ways, actually, I think this is something that should be welcomed, because actually the internationalization of the renminbi could go a long way to redressing some of the financial imbalances that lie at the root of some of the tensions between the two countries. But you asked me the question about how they might go about doing this. Well, today the fact is that none of the financial infrastructure that is required to support that Chinese portfolio outbound investment and China's currency internationalization really exist. And so you will have to create a safekeeping infrastructure for Chinese investors to hold their international securities in. They're very unlikely to go to Belgium to hold those in Euroclear, or to go to Luxembourg to hold them in Clearstream, because of the financial security risk. There exists no such infrastructure today, so one will have to be built, and a jurisdiction will need to be found for that to happen in. I don't think I'm speaking with too much bias when I say that I think that the obvious place for that infrastructure to be located is in Hong Kong. Not just simply because that provides the Chinese with a level of financial security, because it's part of one country, although it operates a different legal and regulatory system to the rest of China, but also because it operates a system in which Western investors have been very comfortable over the last 3 decades in using as an intermediary for their investments into the mainland Chinese markets. So I think that's something which will have to be built. You also need then to have China begin to think about how they structure the beginning of that flow out. And I believe that you will have to select your destinations for that investment very carefully, because it is such a huge amount of capital. Any recipient of that capital, if it were all to land at once, would experience massive destabilization. So the reality is that Chinese policymakers will have to create some sort of a quota scheme to control and moderate the flow of capital out. If I were a betting man, I would say that the most likely initial destination for that capital would be within the Asia Pacific time zone, largely because the economic and trade links between China and the rest of Asia are so significant now that there are very good reasons for issuers in those countries to issue in renminbi. And so when you look at that, if you had Chinese investors able to make that portfolio investment out, investing in local markets, but using a safekeeping center or depository center in Hong Kong, you have the basis of huge development in capital markets, akin to effectively the creation of the euro-dollar market between the 1950s and 1980s. And what I see developing over time is that issuers, whether they be corporates or governments, will, if they are able to access China's pool of savings, will start to issue more in renminbi. And what you'll see is the beginning of the beginning of a offshore renminbi securities ecosystem. This is also critically important for China's trade and China's trade counterparties. So one of the little reported facts from a few months ago, I was actually quite surprised that how little attention that it got, was that Saudi Arabia announced several months ago that it would begin for the first time to accept renminbi in payment for oil exports to China. If you look at the current oil price and current levels of exports, what you're talking about is something akin to between 75 billion and 100 billion US dollars worth of renminbi is going to have to be recycled in capital markets. And so both for China's own sake in terms of its saving deployment, but increasing for other countries that are doing business with China, they are going to need to see this offshore ecosystem to develop. Now, I think I am a very strong believer in the integrity of Hong Kong's legal and regulatory system. I believe that you've got to be open-eyed in that there are reasons why some might not feel so confident today about that, and you've also got to look at the geopolitical realities in that over time, no country is going to want to go into a system where they believe that over time, that means that another country will have an disproportionate amount of influence over their either diplomatic or foreign or domestic policies. And so for other countries going into this system with China, they are very reasonably going to ask for structural protections in that system. And so I don't believe that you're going to create a system. I don't believe that the Chinese will be successful if they attempt to create a system in which all of the securities issuance as well as the depository and trading goes to Hong Kong, but rather Hong Kong will be a major node within an international network where capital flows to individual markets. And if you think about the securities that will sit in Hong Kong as a safekeeping center, inevitably international investors are going to want to mobilize that pool of capital or that inventory as collateral in international markets for short-term borrowing or to meet margin requirements. And so you can see a system of financial markets and a secure system for all parties to the system developing through a nexus between Hong Kong as a depository center and as a collateral management center. People, I think, would be quite happy to take a pledge of collateral under Hong Kong law, but where the deployment of that capital as to meet margin requirements and other clearinghouses happens in other financial centers. And the most obvious one out there is London, because of the London clearinghouse's disproportionate market share in the clearing of global swaps.
Fascinating stuff, and we could go on for a long time to come, but I think it's very, very interesting how you're looking at this Parallel Payments Institute. We are on the cusp of actually running out of time today. We're talking about James Falk on Financial Cold War. So James, let me quickly accelerate to the last question of the show. We've talked a lot about incredible changes in China. Where do you think the capital market revolution goes next?
There's an extraordinary shift going on in capital markets, and this is going to affect trading, and it's going to affect liquidity in markets for a long time to come. First of all, the shift, I think, led principally by NASDAQ to move from traditional exchange mainframe connectivity infrastructure into cloud-based infrastructure. I think we'll start to be able to bring many small markets which have not been prime beneficiaries of the growth in global liquidity over recent decades more into the center of the system because of the reduction in connectivity costs and the consequent ease with which global investors will be able to bring their liquidity to those markets. The innovations in post-trade, I think, are even more astounding because the advent of whatever you think about cryptocurrencies and so forth, the technology that underpins them is going to be transformational in markets in terms of the efficiency that brings, not just in terms of reduced costs and more efficient processes, but in terms of the fungibility of liquidity across markets where previously that liquidity had been very, very siloed. And so I think that the markets, not just because of the advent of China into the international system, but because of the shifts in technology that have accelerated and continue to accelerate in financial markets, will lead to a massive transformation over the coming decade or two.
That is an incredible macro point on which to end. Thank you very much. We have had an amazing guest for the course of this hour, the author of Financial Cold War, James Falk. He's been giving us an incredible macro view. And I think the one thing we really understand a lot better from this discussion is to get a better Chinese perspective and the misunderstandings and the risk of misunderstandings that can arise throughout the course of the different issues from a very, very fast rising financial power and economic power. And actually, we got on to the end to cloud computing and other issues, which unfortunately I wasn't able to ask the question I was fascinated about, which was actually, how does China manage to move forward given the fact that it currently lags in semiconductor computing power? There's so much more here to unpack. Perhaps we'll be able to get you back in the future, James, to discuss more of these topics. Here's hoping we don't have too much Cold War in the meantime and we have much more good relations and encouraging opportunities for China to invest their renminbi overseas. We're going to have a great discussion. Next week's guest is Peter Reitz, the Chief Executive Officer of the EEX, Building Sustainable Commodity Markets Worldwide. How can an exchange build commodity sustainable markets? That's our next show coming next Tuesday. For me, for today, it only remains for me to say thank you very much, Patrick L. Young, for watching this fabulous show. Thank you to our guest, James Falk, and to our list of commenters and questioners. Really appreciate the input from Peter Bridgewater, Les Calvert, Marcus Ward, Peter Second, Simon Huckle, and Peter Best. Ladies and gentlemen, I wish you all a great evening, and indeed, I hope that this will mark the beginning of the end of the Financial Cold War. Thanks for watching.